Okay, Team 2, we are live and you are good to start when you're ready. Maheen, please unshare the slide deck, and Team 2, if you'd like to share your screen, feel free.
All right, everybody. Good morning. My name is Paul Dubois.
I'm Sam Wu.
I'm Daniel Wu.
And I'm Maya Kara.
And today we'll be presenting our conclusions, recommendations, and analysis for the takeover bid, the offers, and other notable considerations. So just a brief rundown of the topics we'll be discussing today. We'll begin with the overview of tasks, followed by our conclusions for each task. Next, we'll discuss Ye's equity value and the valuation methods we used. And after that, we'll talk about the valuation of Notorious's takeover bid and the shares versus cash considerations regarding the takeover bid. Next, we'll discuss the offers presented by both TechTop and MMI. And the last thing we'll talk about is the shareholder agreement considerations before diving into the Q&A. So task 1 was to consider the reasonability of Notorious's takeover bid when compared to Ye's equity value. And task 2 was to discuss any considerations between cash versus shares related to the takeover bid. Task 3 was to make a recommendation between the MMI and TechTop offers while taking into consideration any strategic factors. And task 4 was to discuss any relevant terms shareholders should acknowledge when making a shareholders agreement. So based on our analysis, Notorious's takeover bid is not reasonable due to a lower net present value when compared to Ye's equity value. When comparing between a cash versus shares payment, shares carry key 3 downsides in terms of control, liquidity, and tax implications. So shareholders will benefit more from a cash payment. Between the TechTop and MMI offers, we recommend shareholders should pursue the TechTop offer due to a higher net present value, which will maximize shareholder wealth. And lastly, when making a shareholders agreement, shareholders should focus on outlining 3 key items: the valuation of shares, buyout options, and the control and equity structure. So before we discuss the valuation methods we used for Ye's equity value, I'd like to take time to explain the factors we took into consideration when calculating Ye's weighted average cost of capital. For Ye's weighted average cost of capital, we based it on Ye's current capital structure, and it takes into account three components: the cost of equity, cost of debt, and the cost of preferred stock. The cost of equity was calculated using the build-up approach, and we made various adjustments in equity risk, size risk, industry risk, and company risk. For the size risk, we assigned a 4.2% premium due to the fact that Ye has a smaller market cap. And for the industry-specific risk, we assigned a 7% premium to account for the fact that Ye operates in the technology industry, which has a high exposure to change. For the company-specific risk premium, we assigned a 2% premium to account for the fact that Ye's 2023 financial statements are unaudited and may present some material errors. For the cost of debt, we use a market rate of return on secured corporate loans because Ye has excess assets it can use for collateral. And for the cost of preferred stock, we use the market rate of return plus the expected growth rate, giving us a weighted average cost of capital of 12.9%. For the valuation method, we use the capitalized earnings approach to determine Ye's equity value. The capitalized earnings approach calculates enterprise value by discounting net income with a capitalization rate. So to begin the calculation, we had to first determine normalized earnings before interest and taxes. And to do so, we started at pre-tax income and adjusted it for interest and donations. So in this case, donations were a discretionary expense. So we added it back because it is not needed for Ye's operations. Next, we determined an appropriate range using averages. So for the lower end of the range, we used a simple average of all 6 years. And for the higher end of the range, we used a weighted average of all 6 years, putting a stronger emphasis on the latter years, which is more representative of Ye's future cash flows. For the capitalization rate, we took Ye's weighted average cost of capital, adjusted it for inflation, and we got a capitalization rate of 10.4%. The final value that we calculated for Ye's equity value is in a range of $151 million to $185 million, with the midpoint being $168 million. The reasons why we use a capitalized earnings approach is because Yay is a less capital-intensive business. So in this case, the accounting income for Yay is a good proxy for Yay's cash flows. For the valuation of Notorious's takeover bid, we had to calculate the earnout value in order to determine the full value of their offer. So we begin with Yay's revenue from 2023 as the base, and we forecasted the revenues for the next 5 years. Oh, sorry about that. Yeah, so we used the revenue base from 2023 and forecasted the revenues for the next 5 years. The growth rate starts at 15% in 2024, and it slowly declines by 1% per year going forward. So based on our analysis, Yay qualifies for the earnouts in 2025 and 2028, which is indicated by the green highlights. For the present value factor, we calculated it using Yay's weighted average cost of capital, and we adjusted it for inflation and risk, giving us a real discount rate of 15.1%. By discounting the earnouts, we calculated the present value and added it to the initial cash payment of $120 million, giving us a total value of $159,900,000.
To summarize our findings and assessment of Notorious's takeover bid, we've deduced 3 key factors in our decision-making. Firstly, the numbers don't really provide confidence. The NPV differential between the equity value of Yay and the takeover bid is a material difference of $9 million. Secondly, Yay shareholders have made it apparent that they would prefer to maintain control over Yay's activities. It is reasonable to conclude that this takeover bid, even if the shares option is considered, would leave Yay shareholders with minority interest and the direct loss of control and influence on Yay's activities. Lastly, a portion of the value in this takeover bid is related to the earnout, which carries its own set of risks if the growth targets are not met. Ultimately, this led us to conclude that Notorious's takeover bid in its current state is not reasonable. Following this, although we've determined the takeover bid doesn't meet expectations, we'd like to outline considerations for the evaluation between cash and shares. It's important first to understand that accepting shares is accepting both the terms related to those shares and the opportunity cost of not utilizing the cash elsewhere. In our analysis, the shares come packaged with 3 key issues related to how we evaluated their current value. Firstly, the shares offer a lack of control, which we've mentioned is a key factor for the shareholders of Yay. There's no guarantee from Notorious that the shares would be anything more than a minority control. Secondly, the lack of liquidity when you consider the 1.5-year restriction on trading suggests that the shares should be discounted, especially with no guarantee on the growth of the shares after their recent IPO. And finally, the tax implications of selling public shares versus Yay shares that qualify for the lifetime capital gain exemption needs to be discussed. There is tax savings available that can be missed if the shareholders of Yay accept the shares of Notorious over the cash. It is common practice to apply a discount when considering shares with restrictions and limited control, and therefore we believe an estimated discount of 30% would need to be applied. This evaluation in total leads us to believe that the cash consideration is going to be more beneficial for shareholders and leaves the opportunity for the other investment practices that might generate wealth in the future.
Okay, next we'll start examining our valuation of the fair market value of the MMI offer. There's 2 parts to the offer. First, the initial issuance of 45,000 shares. Second, an additional 25,000 shares if MMI reaches their goal of selling at least 1 million vehicles cumulatively over the next 6 years. So we forecasted MMI sales to determine whether we would qualify for the additional 25,000 shares. This was done by multiplying the forecasted sales rate by a growth multiple of 3 to determine the adjusted sales growth rate and calculating the expected units sold each year. Our results show that by 2029, MMI will reach their goal of 1 million vehicles sold, thus qualifying us for the additional 25,000 shares. Next, the resulting EBITDA is determined. With an expected 20% increase in the sales prices, the vehicles would sell at $60,600 each, and expected revenues as well as the cost of goods sold could be calculated. Furthermore, there exists the likelihood of unionization by production employees if wages are not adjusted, and it is included as a line item. There is an equipment reducing production costs by 5%, which are expected to be installed at the beginning of fiscal 2026 at a cost of $2.8 million. Because this is an asset, we can recover the tax associated with its purchase, and after the installation is finished, the resulting reduction in production costs would start immediately in the same year. To determine MMI's weighted average cost of capital, we use a production manufacturing income tax rate of 26.5%, as well as an optimal debt-to-equity ratio of 1.03. For MMI's cost of equity, we applied the build-up approach, whereby we started with a risk-free rate, adding percentages based on individual level of risks that apply to the company. We first used a 20-year risk-free rate of return, as well as a 15-year equity risk premium, because we wanted to represent the normal business cycles of a company. Next, an industry standard risk premium for vehicle manufacturers at 5% was added. Finally, we included a specific risk for MMI at 5%. This is because of the negative media attention that MMI has been receiving, as well as the lower liquidity of its shares because MMI is a private company. The cost of debt is also based on the market interest rate on secured corporate loans because MMI has excess working assets that can be used as collateral. So the fair market value of the initial offer was found with the discounted cash flow method. This method was chosen for two reasons. First, because there was an availability of forecasted cash flows that were based on independent market research that would give an unbiased opinion. Second, there were irregular cash expenditures within the forecasted period, which proves the discounted cash flow method to be more effective in this situation over other methods. The discretionary cash flows were discounted to present date using a real discount rate of 12%. This rate includes the weighted average cost of capital of 11.7% with an inflation rate of 2.5%. We included a 3% risk factor due to the uncertain cash flows as well as the unaudited financial statements. This discounting is required because the share values are based on a 6-year forecasted period ending 2029, although we receive the shares immediately after signing the contract. Furthermore, we added a terminal value amount at the end of 2029 to forecast cash flows that would occur after the 6-year period. This amount was to estimate the continued growth of the MMI shares even after the end of the strategic partnership. Included in this amount are a risk adjustment of 7% as well as a growth rate of 4%. A notable item was the amount for litigation that likely had to be expensed by MMI. However, this would instead increase the final equity value because there was an expected 75% chance of a positive outcome. So from these calculations, we found that the fair market value of MMI's current common shares, and using that, we value the initial payment of 45,000 shares to be $277 million.
Now, alongside the fair market value of the 45,000 common shares that will be received for the initial payment of this offer, we determined the valuation of the 25,000 shares expected to be received if MMI meets their goal. We use the capitalized cash flow method in order to determine the standalone value of MMI, which would be the value without Yays Technology. We normalize their EBITDA by removing prior revenues and expenses that are non-recurring. As the cash flows from 2021 are not representative of future cash flows due to the defective inventory, we removed 2021 when calculating our averages to reach our range. Next, we utilized the capitalized cash flow method, and we had access to MMI's historical earnings and with MMI being a capital-intensive yet mature business. The determination of the capitalization rate involved the deduction of inflation from our previously computed weighted average cost of capital. Using the capitalized cash flow method and the range determined, we calculated the fair market value of MMI's shares, which was a range between $3.3 and $4.3 million. By dividing the fair market value by the total outstanding shares, we derived the per share value and computed the midpoint value of the 25,000 shares to be $127 million. While this value is anticipated based on the forecasted sales projections of MMI, its realization remains subject to the contingent nature of MMI's future sales performance. The combined valuation of MMI's initial and contingent offer equals $404 million. Now, for the valuation of TechTop's licensing deal, which entails receiving a royalty fee for each vehicle sold within the contractual period, we conducted an evaluation of the projected sales growth, This involved using a growth rate with a sales forecast projected from the vehicle industry. And this allowed us to anticipate the volume of vehicles sold over the contractual term of 6 years. Under the terms of the agreement, the licensing fee underwent an increase from $1,250 USD to $2,500 USD in the year 2027, due to the cumulative sales projection of over 250,000 vehicles sold, as stipulated within the contract. Additionally, the 25 million USD payout was factored into the 2029 earnings, as stated in the contractual terms. We included an uncertainty risk, as the growth multiple of 4 might be a biased rate given from TechTop. We discounted the cash flows using a rate adjusted for inflation and uncertainty risk and reached a rate of 15.1%. The net present value of TechTop's offer in Canadian dollars was valued at $530 million. This NPV is above the cumulative FMV fair market value of MMI's contingent shares and initial offer, and therefore we recommend Yay to pursue TechTop's offer. Now, in the process of formulating our recommendation, we have examined the strategic implications associated with both offers. TechTop's offer, with this consideration in cash, holds the advantage of being more liquid. This would be advantageous for Yay, particularly if they have plans for future investments. A strategic move would involve delving into TechTop's prior financial statements to gain a comprehensive understanding, as there is a risk of them not meeting their sales forecasts. Yay won't have exclusive rights to their unique technology after the payout by TechTop. TechTop, therefore, will have the ability to further develop the software from Yay. Regarding MMI's offer, they offer the prospect of a strategic partnership, and this could be advantageous in the terms of promoting Yay's technology through their advertising campaigns. As MMI is a private company, it will be harder to eventually sell their shares, therefore reducing the liquidity of the offer. And last, it is important to note that a significant portion of the shares offered by MMI is contingent upon their sales performance.
Our last topic today is to discuss the key points our shareholders should consider when creating a shareholder agreement. The 3 key elements we suggest you focus on are the valuation of shares, buyout options available, and the control and equity structure of the company. Firstly, the valuation of shares covers the important provision that will determine the method that the shareholders agree will evaluate the value of a shareholder's equity within the company. Although we've listed a few methods here for your discussion, we would like to recommend the first option, which is valuation by independent valuator at a later date. It suits the needs of the shareholders and takes into account the need for their future valuation of shares related to the 5-year retirement plan. Secondly, it's important to outline the buyout options that a shareholder has for the disposition of Yay's shares. This provision provides restrictions and options for shareholders when considering selling their equity within the company. We've outlined a few options here, but would like to recommend the right of first refusal, as it gives the shareholders an opportunity to keep the shares within related party members at their discretion. Now, thirdly, there should be a key provision related to the control and equity structure of Yay and the role that each shareholder holds within the company. This will clarify the level of control and determine the restrictions on individual shareholders' actions within the company. Key items to consider when determining this provision include the relationship of Victoria's no voting preferred shares versus Brian and Eric's common shares, as well as the previously suggested personal elements of retirement and marriage that may require additional provisions and restrictions. Overall, the agreement should be generated with a legal expert and mediated by a third party to ultimately provide an equitable agreement that supports and benefits the shareholders of Yay. Now, before we conclude, we wanted to provide additional confidence for Yay's shareholders in their decision-making. To do so, we benchmark Yay to the comparable tech companies to determine current performance to help validate our projections. This valuation here has shown that Yay is a strong contender in the tech industry, with its unique proprietary technology performing above average within the market. Now, in conclusion, we have covered the items we were tasked to analyze and present. Yay shareholders have significant advantages in generating wealth if they navigate the offers and bids appropriately and follow our recommendations and considerations with care and diligence. Doing so, we believe, will maximize shareholder wealth and maintain their considerations within Yay for the future. It's at this point that we'd like to open up questions, if there were any, by any of the shareholders or the advisory board. We'd love to consider them with you. Thank you.
Thank you very much. That was very good. Very much appreciate that. Just maybe I'll start with a question. It is actually that last page I think you had. Maybe you could just flip back so we can kind of scan that with a little more detail. So just tell me a little bit more here as to what you did with this and what you considered, I guess, in sort of in the valuation, if anything.
I can speak on that. Thank you. As far as this particular slide in this analysis goes, our consideration here was to utilize the data to benchmark Planet Yay specifically against the other tech companies, because it's common in the tech industry that companies, there can be particularly a bit of risk in how long the candle keeps burning and how much the company continue generating wealth, considering that the technology industry moves quite quickly. We wanted to compare them so that the shareholders of Yay know their current position, know roughly the projections, and kind of can estimate the efforts of Yay going forward. We believe that they're going to continue to be a strong performer. Proprietary technology typically has its strong, unique advantages within the tech industry, and it's very clear that Yay has that advantage. So we just wanted to showcase that by highlighting some key indicators and showing that they're above average within the market.
Thank you.
Can I ask a follow-up question to this schedule that we have in front of us? So I noticed you've looked at two different multiples, your enterprise value over EBIT and your enterprise value over revenue. And when I look at the comparables that are listed here, there looks to be quite a large range in the multiples. So for example, the enterprise value over revenue, you've got a low of 1.17 up to a high of 2.43. And I'm not sure what the different colors of shading are, if they're meaningful on this schedule, but did you look at any of these individually to determine if any was more comparable than any other?
Yes, yeah, thank you for the question. We absolutely did. The color, frankly, is really just to show the top 5 and bottom 5 performers, as there are 10 individual companies available here. We wanted to showcase that there was an above average performance. As far as the individual companies go, we did notice there were some companies that were perhaps stagnant in their growth and wouldn't be the best outlier for comparison. We were considering focusing on specific companies that shared similar attributes, both in length. I believe our company Yay is 10 years old. So we found some companies that were within that range of about 8 to 12 years that had similar performance, but they're actually the ones that seem to be doing quite well in our chart here. A good example is the T-unit business that's highlighted there. They also perform above average across the board. So we felt that it was comparable to leave them in, but not specifically highlight them, to just give a broad stroke of the industry.
Thank you.
Hi, everyone. Got a question just around some of the analysis that the team did as part of working through the case. Were there any other considerations that you had with respect to some of the things that you were asked to do that you could comment on, again, if you'd work through that in preparing the case?
So I'll speak to that. So I guess the other considerations that we had, just going back to the calculations that we did for the, so just going back to the calculations that we did for the forecast, especially, a notable consideration was the uncertainty risk that we factored into the cash flows. So for example, the forecast ranges, anything beyond 2024 is usually going to be uncertain. So we assigned in a range of 3 to 5% for the uncertainty risk. So the 3% uncertainty risk was the uncertainty risk rate that we used for MMI's offer, because it posed the lowest risk as an independent market-based researched forecast. And for the other forecasts, we assigned a 5% uncertainty risk, just to account for the fact that these are forecasts coming from their respective companies. So these would be forecasts that would reflect their interest in their own company. So we wanted to account for that especially. I hope that answers your question.
I guess I'm also just curious, were there any other strategic considerations that you deliberated on as you were preparing the case as well?
I can speak on this one. So we mentioned for the notorious offer that there was a $9 million difference between the net present value of the offer and the fair market value of Yay. And this amount we believed would have been material depending on what Yay's shareholders believe is valuable to them, as they would like to gain control and continue having control on their company. We believe that that $9 million was not enough of a difference to make Yay want to continue with the takeover bid. If Yay was willing and okay with giving control over, the $9 million might not have been a big effect for Yay, especially because they have large sales forecasts throughout the years. So that $1 million difference between the fair market value and the takeover bid would not have been too material. However, because Yay already wanted to continue holding on to their control, that $9 million discrepancy was important when deciding on whether this assessment was reasonable. And thank you for your question.
Are there any further considerations that the shareholders or advisory board would like to go over?
I don't have any other. Michael or Eric? No.
I'm good. Thanks
I
for
do
that.
have one question myself. Sorry. The discount rates and the WACC rate for MMI and tech are looks pretty similar. Is there any reason for that?
Sorry, the discount rates used in, is there a specific slide that you'd like to refer
I'm just seeing
to?
8.9 and I guess 9.2 for separate slides. On the contingent shares, you have a cap rate of 9.2 and you have an 8.9 for tech top and the licensing deal. I was just kind of curious. They're pretty similar to each other.
Oh, I see. Well, the capitalization rate only takes into account the inflation. So when we did our calculations there, it was the flat rate of 2.5% being deducted from the weighted average capital cost of I believe it was 11.7%. Whereas the discount rates that we used, it was more, I guess it was a different formula that was used to calculate the real discount rate. And because, again, we adjusted the discount rate for the forecast, the uncertainty of the forecasts, that's why it might look a bit different.
Thank you.
That's all.
All right. If that's all, I'll ask Team 2 to leave the meeting. Thank you very much for your insightful presentation. And judges, you'll be moved to a breakout room momentarily.
Thank you very much.
Thank you so much.
Thank you.
Have a nice day.
Thank you.
Thank you.
Okay.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
Hi, Alan, Lillian. We're going to get started very shortly. We're just waiting for the judges. They'll be joining us in about 2 minutes.
Yeah, no worries. Take your time.
All right. Thanks for joining us today, Team 8. I'm about to hand it over to you, Alan and Lillian. If one of you wants to share your screen, go for it. We're ready to start when you are.
Yeah, perfect. Let me just share my screen.
Hello, today as the only 2 valuation experts in the M&A department of Planet Yay Ventures, we will be walking you through some of the future possibilities of Yay. My name is Lillian Miao and my partner's name is Alan Kung. This presentation will provide a comprehensive analysis of the 3 current offerings that Yay has. First one being the notorious takeover bid, MMI strategic partnership, and TechTop's licensing deal. We will provide a recommendation at the end based off of the evaluations that we have made due to their financial implications and strategic fit with Yay. We will also be discussing some of the key terms and considerations for Brian, Eric, and Victoria's shareholder agreement. First, I will start out with the notorious takeover bid, along with the fair market value of Yay. Before isolating to any offers, we must understand that the business valuation of Yay for all the calculations below, we made assumptions as following. Sales starting at 15% compounded annual growth rate in 2024 and drops sequentially as stated in the case. Gross margins are flat at 85% based on historical data. Operating expenses are based on historical percentages of sales. Amortization and CapEx are both calculated as per the PPE schedule based off the facts given in the case and historical depreciation. Interest is based off the debt schedule, also based on the facts given, and we assume a long-term debt are unsecured at 9% and line of credit to be secured at 6%. The tax rate was provided in the case at 30%, and the net working capital is based on the NWC schedule. We use these assumptions to work out the income statement from 2024 to 2028 and the WACC calculations. Under the case assumptions, we value the earnout at 5% plus the risk-free rate as we opted for 3.5% as the industry standards. Included as well as the size risk premium to reflect Yay's smaller business size after using CAPM, we arrive at 15.7 for the cost of equity, For the cost of debt, we took a weighted average of Ye's current long-term obligations at 5.4%. So combining with the percentage of debt and the percentage of equity, we arrive at a WACC of 14.0%. Combining all of these elements, we have income statement, free cash flow. We discounted the free cash flow to present value using the WACC calculations. With all the calculations on the previous slide, we used two methods to derive the enterprise value and equity value of Ye. First, the Gordon growth method. We assume the businesses would continue to expand at 2.5 inflation rate in the long run. By applying the Gordon growth formula, discounting it back to the present value, and adding present value for the free cash flow from the previous slide, we arrive at an enterprise value of 283 million. Next, for the exit multiples, we multiply the last year forecasted EBIT by the comparable set of companies by size and revenue, arriving at an enterprise value of 220 million. Bringing you away from the quantitative data, we notice that the revenue-based multiples are omitted as they neglect profitability because they don't show expenses, so more weight is put on the exit multiple terminal value. Another important note is management, Victoria specifically, is looking to retire, so we put more focus on exit. For the construction of the football table, we put more weight on the exit multiple DCF methodology, mainly because Ye is a tech company and there is a high growth rate, and it's therefore harder to forecast the future in such an unpredictable industry. Patents also have a lifetime and should not be expected perpetual growth, as it is not reasonable to have a perpetual growth in the model. Ye is such a unique company with no other firms that are similar, so taking all that into account, a purely comparable companies method is not ideal. After considering all of the above, we constructed the football field table to get a final valuation of just slightly over 245 million. Now, with our first initial valuation of Ye, it is time to start talking about some of the offers that we have, starting it with the Notorious takeover bid. Notorious is offering Ye with 120 million outright and provided future earnouts, with an estimation of 17.5 million in 2025 and 35.1 million in 2028. After comparing the earnouts required with the forecast, we noticed that the earnout requirements fall below projection in 2026, but it is met in 2023 and 2028. Hence, we lose that part of the earnout value in 2026. Discounting all of these payments into present value, we see that the earnout and the initial offer would be 173 million, which is less than the initial valuation of Ye. Even if we include the earnout in 2026, we would only get to 199 million, which is still lower. For the payment method of the 120 million they offered, either cash or stocks, there's pros and cons for both. We chose to do the calculations in cash because there's immediate payout and there's less risk and less worry for the performance of Notorious stocks. However, there are high tax rates of 30%. With stocks, Ye can defer the said tax and get a higher sale if the stocks increases. There are also potentially voting rights, but Ye would also have to deal with a lockup period of 18 months, and stock prices may fluctuate during this time, reducing the value. Ye should reject this offer at what Notorious is currently offering and negotiate if wished.
And moving on to MMI's strategic partnership offer. Again, like before, we have a list of assumptions that we have used for the valuation of MMI. So firstly, for these assumptions, in our base case scenario, we use analysts' projected vehicle sales growth and a 20% increase per unit price as per the case. Along for the bull case scenario, we use the same price increase per unit, but with a 3x unit sale growth as per independent market research within the case. And we wanted to be conservative and felt it was quite optimistic, so we set this as the bull case. So for our cost of goods sold, we also have a 25% increase for employees, a 5% decrease for material inputs as per the case. And for operating expenses, we used either a historical percentage of sales or kept it consistent as fixed costs. And we also added in advertising costs as per the case. For the inventory disposal claim, there's a one-time line item reported as expected value of recovery of success, and this is included as per the case. For CapEx, this is as following the information in the case, including a maintenance CapEx of 925,000 per year and a growth CapEx through production of equipment of 2.8 million in 2026. This is put into the PPE schedule. For our CCA deductions, we included a CCA deduction for appropriate items and deducted the UCC and taxes. For our net working capital, we did 2% of revenue as per the case. For amortization, it follows our PPE schedule. For the manufacturing tax rate, we use 26.5% as per the case. And for the private firm illiquidity discount factor, we made this 20% as we felt that MMI is a private company and thus we expect those shares to be less liquid, since it would be harder to buy and sell those shares. Also, as MMI is not a public, the financials are less precise and we want to capture this risk into our share price. So using the above information, we were able to get the instant income statement projections. Now, moving on with some further assumptions, we were able to get the free cash flow for MMI. So starting with their adjustment of one-time items, the inventory disposal claim is not likely to happen again. And for the sake of consistency, we have subtracted this one-time source of income. For the cost of debt, we did a weighted average cost of debt based on current outstanding obligations, same method as we did for Yay. And for the debt/equity ratio, we did this based on the optimal debt-to-equity ratio for vehicle manufacturers that was provided in the case. Same with the tax rate and the industry risk premium, both the manufacturing tax rate and the vehicle was provided in the case, and our industry risk premium was taken from the case for the vehicle manufacturers. Same for our capital gains tax, we got that information from the case. By calculating our WACC, we were then able to apply it to our free cash flow and get to our discounted free cash flow, much like what we did for Yay. Now we're going to find the share price of MMI as part of their offer. First, calculating the case using both the Gordon Growth and the exit multiple methodology, we were able to get the adjusted EV. Then using the adjusted EV, we were able to get the equity value and divide this by the of 750,000 shares, which is the number of outstanding shares to get the per unit share price. And this unit price is the price of the 45,000 initial shares that are part of the offer. And this sums up to a total of $257 million. And now we're calculating the second part of MMI's offer, which is the bonus shares, which is the valuation. Again, we calculated the share prices at this time, but we did it for 6 years in the future, the time of the bonus share offer. Here we can see that the bull case gives us close to $7,000, whereas the bear case is almost close to $4,000. And for conservative sakes, we kept the base price as the share price close to unchanged. Now, calculating the difference between this share price 6 years later with the share price at present day, we can find that the total capital gains, and apply the capital gains tax to get the total post-capital gains tax. And calculating our bear, base, and bull cases on share prices in 6 years, the expected value of capital gains is calculated, and we arrive at a bonus share offer valuation of $3,754.5. And appending to our initial offer price of $257 million, the total fair market value of MMI offer is $261 million. And obviously, there are pros and concerns related to this deal that we should consider. Starting with the pros, MMI can provide marketing and certain expenses, along with a reduction of revenue volatility as is the recurring partnership revenues. And there also is their initial offer price is already fair above a market valuation of Yay. And with this offer, we also get to keep Yay's asset as is a partnership and non-acquisition. For cons, the MMI offers heavy reliance on their sales growth, which means that their share price can swing pretty heavily. And their offer is contingent on MMI's operations. As with 45,000 shares only, Yay remains only a minority shareholder and don't have real power when it comes to voting. Additionally, they have poor reputation. MMI has a prior history of negative reviews in the press, and they are a private company, making their sales prices not as efficient. For mitigants, we suggested include a downside protection clause, such as to put options to mitigate bear case scenario damages, and to offer more shares or include preferred voting shares to give Yay shareholders more involvement and say. And we also request that MMI not have exclusive rights of Yay's technology potentially. And moving on to TechTop's licensing offer. Finally, with the TechTop valuation, again, we have a list of assumptions that we'll go through quickly. So for the undiversified revenue streams, Yay's revenue streams is from one software. Hence, we replaced Yay's revenue with a map related to TechTop's exclusive rights and royalties as per the case. And for our TechTop exclusive rights, entirely of Yay's revenue will be from TechTop. For our sales growth, is consensus times 4x starting at 2025. Hence, in 2024, there will be no sales yet, but there will be expenses to maintain the facilities. And this is as per the case. And for our royalties, we have $1,250 USD per vehicle for the first 250,000 vehicles. Afterwards, it will be $2,500 USD for every vehicle afterwards. For our FX rate, we used a 1.15 Canadian over one USD. For other expenses, aside from cost of goods sold, the other expenses are treated as sunk costs, as those costs will be incurred regardless. For our WACC, we did 15.7% by including a size premium, since TechTop is a new and small business, and given the size of the US market, there is definitely more competition. For the exit price, the source code sale will be 25 million USD, and is deemed as Yay's terminal value. So using these, we're able to forecast the free cash flow below. Now, again, with the bull and base cases, we already get a weighted average of $311 million. And these cases are constructed by different sales growth rate adjustments. And with the bull case being the 4x growth as per the case facts, and the bear case being the annual projections. With the TechTop offer, we would need to sell the source code, and this means that the source code is essentially the bread and butter of their business. And so it's likely that after the sale, Yay is essentially worth nothing anymore, besides the remaining assets. So hence we have added the minuscule sales of these assets like their furniture and equipment to get the final value. There are also pros and concerns with this deal as well. For the pros, they have strong cash flows and stable revenues. They also have an exit option for shareholders like Victoria, and they have their offer price is also above the fair market valuation of Yay. But another pro is that product may be replicated over the years by other firms. So locking down an exit price earlier can be beneficial so that we prevent any lower valuation in the future. For concerns, we have valuation stems from like TechTop's performance, since TechTop is also a young firm. And without the source code, Yay is also essentially absolute, which would be a concern if Yay could exit at a higher price in 2029 or elsewhere. Otherwise, Yay would also need to increase R&D and invent a new flagship product after 2029 if they plan to stay in operations. For mitigants, we can include a downside protection cost to mitigate poor sales and provide an early exit option. We can also provide an option to extend the royalty term, or request that TechTop does not have exclusive rights to Yay's technology after the offer, or we increase the sale of our source code at the end of the offer. Moving on to evaluation summaries and next steps. Now that we evaluate all the offers, as mentioned before, Notorious offer is way too low and should be rejected right away, as it's lower than essentially doing nothing, the original price of Yay. And it's likely that Notorious lowballed their offer and did not factor in synergies and that there were other bidders. Hence, the earnout offer is low. Maybe after rejection, Notorious can come back with an improved offer. Anyway, as of right now, it's more realistic to consider the offer between MMI and TechTop. And while there's a large discrepancy, there is a reason why. Remember that TechTop does offer means that Yay no longer exists, as the software sale means that it's very likely that Yay is worth nothing afterwards. So, however, in the case of MMI, after the partnership is terminated, you still own the software. So hence this decision between MMI and TechTop should be based on, one, the shareholder decision to keep operating or exiting. With MMI, you continue operating. With TechTop, you would have to exit because you have no software anymore, or you have to spend a lot of money on R&D. For our second decision criteria would be based on the exit valuation in 2029. On an apples-to-apples basis, we want to see that the exit value sale of Yay in 2029 and add that to MMI's offer to capture the scenario of MMI's offer plus the sale of Yay in 2029. Since the difference between the current MMI and the TechTop offer is 51 million, as long as this exit value sale of Yay in 2029 is over 51 million, MMI should be the better offer. And finally, the partnership versus royalties. A strategic partnership is more stable. And doing a quick calculation using the multiples in the case for Yay already, we can see that an exit multiple sale of Yay in 2029 is worth approximately $111 million when discounted the present value. As this is more than $51 million, the total consideration of MMI is better than that of TechTop's. Hence, we should pursue MMI's partnership offer unless better terms can be negotiated on the software exit sale for $25 million, since it is too low. Perhaps higher royalty fees can be negotiated in as well. In summary, the pros for MMI's offer are as following. So MMI gets to keep Yay's assets as a partnership and not an acquisition. They are also a more mature and stable company, providing more stable revenues. When it comes to cons for MMI, they are at a lower valuation, and we do run the risk of competitors creating better software, decreasing our exit valuation in the future. And MMI is also a private firm, meaning the shares are highly illiquid. For the pros of TechTop, we can see that there's a higher upfront cash flow in the next few years, and we can realize the time value of money. And there is also a retirement exit. With the cons of the TechTop offer being that they're a younger firm with more volatile sales, and we lose the software at the end of the offer, which is the key asset for Yay. On a pure valuation basis, we would deem that MMI's offer is the better offer, but this is also subjected on the other factors that we discussed before. And with the projected exit, we expect the next steps to be as following: renegotiating and rejecting the Notorious bid, which could be a potential acquire 5 years down the line with a more appropriate valuation. Then we would discuss with shareholders on whether to exit or continue, and based on that agreement, we would choose which offer to lean more towards. On a pure valuation basis, we would go with the MMI's offer currently, and then when next we'd engage with a letter of intent with the appropriate parties, conduct our due diligence, our site visits, conduct our deal term negotiations, and appoint our legal team to create and execute those agreements. And then we will receive regulatory approval and conduct shareholder votes. And finally, we will have the closure of our deal.
Well, we have found the optimal offer to consider. Some of the next steps for Yay, and also it's also very important to note that we need an agreement among shareholders. Yay is currently looking to create a shareholder agreement, so we've outlined some of the key terms to focus on, starting with the ownership and terms. Management committee, we want to know how many are there and if there is a cap. Currently, we have 3 founders. Brian, Eric, and Victoria. Is anyone else part of the board? What are the responsibilities? We need to know this, especially given that Victoria is looking to retire soon. Also, we would need to know what counts as majority for approval. For smaller things such as debt borrowing, maybe you need less, but to require approval for M&A, a super majority is required. In this case, Yay is certainly likely to go under a transaction process very soon, so this is important to establish. Shares. What are the privileges of each type? Because Yay has both common and preferred shares. How are they distributed? Voting rights. Is it one vote per share? What are the voting restrictions? Deadlock resolution. If there is a deadlock when making decisions, there are three founders and all three founders have opposing opinions. Which offer should we take? How should it be resolved? Do we bring in a third-party expert or another senior management? Articles of incorporation and governing laws. The region matters for tax purposes and other legal limitations. Yay is Canadian and TechTop is American, so this could be an issue. Distribution policy. Yay pays out dividends on common stocks 2 months from after the fiscal year ends. This should be outlined as well as capital constraints like issues of dividends when bankrupt. Minority shareholder rights. Sets of closures to protect minority shareholders in key/large business changes. We should protect those minority shareholders who disagree with any decisions Yay might make in the future. Shareholders meeting. This one's very straightforward. Location, frequency, and procedures when Yay hosts shareholder meetings. Now, moving on to restrictions and protection. Standstill obligations. When someone new acquires a share, there should be a lockdown period to ensure the stock price stability and reinforce investor confidence. For example, Victoria may sell her shares on retirement, which may be one of the main issues. Right to first offer. If a shareholder is selling their shares, other shareholders should be given first option to bid before third parties come in. Tag along and drag alongs. Factors and majority shareholders negotiation rights in sales, and in case of disagreeing minority shareholders, forcing the minority shareholders to accept deals negotiated by larger shareholders. Both tag along and drag alongs are relevant as Yay has potential M&A. Preemptive rights. If Yay decides to have nothing and keep on growing, they might need to raise equity at some point. Existing shareholders should have first rights to purchase them. Put options. Given the shareholders the rights to sell their shares, maybe in case of disagreement, and if they wish to exit, the option is there given to exit ownership quickly. Dilution protection. If Yay issues shares, this protects minority shares from dilution. Confidentiality and non-disparagement make sure shareholders keep sensitive information private as well as maintaining the brand image. These are just some of the key terms and main terms for Eric, Brian, and Victoria to consider when creating the shareholders agreement. Thank you for listening to our presentation and considering our recommendation.
Thank you very much. That was very good. I'll open it up to my fellow judges to see if they have any questions.
I wouldn't mind asking a question about your TechTop analysis. I don't know if you can flip back to the slide. Okay, so on this slide, you've projected sales every year, and then you've deducted off a cost of goods sold. And I'm just wondering if you can tell us what that is.
Yeah, I can answer this question. So for the cost of goods sold, initially we had some costs in, but after revision from the judge feedback last round, we removed those and we only did our cost of goods sold. And the cost of goods sold is essentially our licensing expense that we have for providing our software to TechTop as a variable cost.
So what would be included in that?
It would just be the expense of essentially licensing our software to TechTop to use in their products.
Okay.
Any other questions? Doesn't sound like any.
Okay, if there's no other questions, we'll adjourn for deliberation. Thank you, Team 8, for your great presentation. You guys can leave the meeting, and judges will move you to a breakout room.
Thank you.
Thank you.
Thank you.
What if the things that captivate you, the passions that drive you, everything that makes you, you could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
Hello, Team 10. How's it going? Congrats on making it to day 2. We're going to get started pretty shortly. It's going to be about a 5-minute extra wait, though. The judges are still deliberating, so we're targeting 1:05 p.m. for our start time, okay? So just hang tight, and as soon as the judges start coming in, we'll kick things off.
Thank you.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
All right, Team 10. It looks like we have all of our judges back from deliberation, so feel free to get started when you're ready. Good luck.
Thank you so much. I'll just share my screen here with everyone. All right, is everyone able to see the screen fine? The sale of your business is one of the most important points in the life cycle of the company that you created from the ground up. Victoria, Eric, and Brian, you've created a phenomenal business and you need phenomenal advice to deal with these challenges that you're facing today of having 3 third-party offers on the table. Today, we are so proud to present to you our presentation on the sale of Planet Yay for the CBV Institute 2023 Business Valuation Challenge. We are the Yay M&A department, and my name is Alex. I'm joined by my colleagues Alan and Talon. So to go over what we're going to go over for you today, first off, we're going to start with an executive summary. We're going to go over an analysis. We're going to create for you a shareholders agreement. We're going to provide a valuation of the 3 different offers you have on the table, then go over some risks and mitigation, and once again, go over what we did for you today. But first of all, your key problem is you have 3 offers on the table, and you need to determine which offer you should accept and how to mitigate potential shareholder dispute. After this, we need to analyze what method we should use to value your different offers. You need to establish a shareholders agreement framework, as you do not currently have one. And then we would recommend you pursue the deal with Notorious Tech. And the impact of this is you now have a framework to identify and manage disputes, identify different offers, and make informed decision about impactful events. And in the end, we believe you should pursue the offer with Notorious Tech. So to go over different valuation methods, there's 3 different valuation methods that you can use. First of all, there is the asset approach. This is a valuation method that you would use if the business is extremely asset heavy and that there's no goodwill in the business, or that the business is not a going concern and that the value of its assets exceed its cash flow. There's 2 different types of methods for this: forced liquidation and orderly liquidation. But because your business is extremely cash flow positive, we do not believe that the asset approach is a correct method, as your business is more valuable under an income approach. Moving on to look at the income approach. There's 2 main methods in the income approach that I'll dive further into in the next slide, But the income approach is an approach that you would use if your business is very cash flow positive and is expected to remain a going concern moving forward into the future. And finally, we have a market approach. This is an approach that you probably would not want to use as your primary valuation method, but it is a great gut check of your valuation methods before to see if the market agrees with your valuation. Because at the end of the day, if no market participants want to pay for what you valued your shares at, then there's no way that anyone's going to pay for the price you've come up with in a different method. So we'll gut check our findings with the market approach. So to define value, value is the price you pay, value is what you get, as Warren Buffett once said. Value represents the fundamental value of your business, and it's the highest price that a third-party buyer would be willing to pay for your business. Price is affected by factors of supply and demand, and is the price at which someone is willing to sell/buy at. So as we've decided the income approach is the most appropriate approach for your company, let's go over a couple different income approach methods. First of all, there's a discounted cash flow approach. In this approach, you start with the forecasted cash flow from operations, remove income taxes. To get your operating cash flows, you'd remove your CapEx net of a tax shield, to your present value of discretionary cash flows. You'd add present value of the terminal period, i.e. your ending period, present value of the existing tax shield, to your enterprise value. You'd add back the net realizable value of your redundant assets, remove interest-bearing or third-party debt to get your fair market value of equity or the shares that you have today. And there's also the capitalized cash flow approach, which is quite similar to the capitalized earnings approach. In this approach, you'd start with earnings before interest and tax, add or subtract normalized adjustments, subtract income taxes to get your after-tax maintainable EBITDA, subtract CapEx and have a tax shield, get your maintainable cash flow times by a cash flow multiplier, get your capitalized cash flow, add the present value of your future tax savings on your current unclaimed capital costs, and just like in the other one, get your enterprise value, add your redundant assets, remove third-party debt to get the value of your shares. So these two approaches are good for different purposes. Discount cash flow approach is good when the business is a going concern, there's forecasts, they're prepared, and the assumptions are reasonable, whereas a capitalized cash flow approach is appropriate when the business is at least moderately capital intensive. Depreciation for tax purposes differs greatly from depreciation for accounting purposes, and that historical results are indicative of future results. But as your business has been growing vastly year over year, we don't believe that your historical results are indicative of future results. We believe that you can continue growing, especially with the forecast assumptions that are provided by Notorious. So we have selected the discounted cash flow approach as the most appropriate valuation method for your business. But with this valuation method, you still need a shareholders agreement framework, as your company does not currently have a shareholders agreement. You need this framework to manage risk of dispute and assist in major business decisions. This is going to allow for you to have a standardized set of rules for fairness and dissolution, and also provide risk mitigation for harming events. So for the shareholders agreement framework, you have multiple steps you need to do to complete this. You need to engage your legal team and have a CBV, so you have expert participation in the creation of your agreement. You need to hold a focus group between Brian, Eric, and Victoria to determine commonalities and concerns for future business decisions. You need to then have a valuation date for the purposes of the shareholder agreement, determine an action plan based on major differing life events and major different business events for its shareholders, specify roles and responsibilities of the shareholders, specify classes of shares and circumstances as to when new shares can be issued, create provisions on when the shareholder agreement can be changed and altered, and have an action plan based on differing major life events of the business and its shareholders, which I'll get into in the next slide. Overall, the development of this framework will allow for the business to apply an appropriate framework in the identification and how to deal with major decisions and major life points of the business. And we would like to have the shareholder agreement framework developed within 3 months of negotiations. So to go over major differing life events, we've identified 5 potential options that you can have in your shareholder agreement to deal with major events. One event that you don't necessarily want to think about, but it's important to consider for a business, is death. If a major shareholder dies, you need to have a plan in place to manage risks of the business. Pursuant to subsection 70-5 of the Income Tax Act, you need to have a valuation done on the day immediately preceding death. So it's important to have a clause in this to understand what you'll do in your shareholders agreement in the event of this happening. And this needs to be a bona fide agreement for the purposes of the business and not to avoid taxes. Next off, looking at retirement. As Victoria wants to retire in the next 5 years, the eventuality for retirement creates a need for a clear plan on how to tackle this issue. You can implement things such as a mandatory retirement age to allow for the assurance of performing shareholders to keep the business viable and performing well. You can include a non-competition and non-disclosure requirement so a leaving shareholder won't impact shareholder value on the way out. You can also consider other considerations such as rights to specific work schedules and assets that could be taken away from the business on dissolution, as sometimes private businesses have assets commingled with the business operations itself. Looking at marital breakdown, another sad thing you don't want to think about, but important for a business. Brian is getting married soon, and we want to separate personal life from business life. Business interests need to be protected if and when shareholders get married. Shareholders would need to sign an agreement so the shares of the company do not make up a marital asset pool, because upon a marital divorce, the shares of a company would be available in a marital asset pool for the purposes of divorce settlements. The non-participating spouse would be required to also sign this agreement, so this provision would stand up in family court. If the above is not possible, you can implement a mandatory call option so shares could be paid out in the marital asset pool at a fair value predetermined. Corporate divorce is another thing. Multiple offers on the table. People might not share the same strategy moving forward. So you can include provisions such as termination for cause, so that shareholders can be bought out at a predetermined price. You can have punitive clauses, so it's to incentivize performance and protect the interests of remaining shareholders. And you can also include a shotgun provision, so a predetermined price can be guaranteed for buying out the shareholder in question. And finally, the most important for you today, you have 3 offers on the table. You have 3 third-party offers, so you need a clear set of rules and predetermined rules for evaluating transactions. You can implement restrictions such as offer acceptance on right of first refusal. You can implement tag-along or drag-along rights and have a clear process on how to sell the business in the event of a third-party offer. And we'd recommend for all of these that you engage a third-party CBV to determine the fair market value of any offer.
Thank you, Alex. We'll now move into the valuation of the given offer, starting with the weighted cost of capital for Planet Yay. We started off with a risk-free rate of 3.5%, then examining the Dumbledorian Index, one of the most respected professors and sources of financial information. We attached a beta of 1.47. Given the size of the company, we added a premium of 4% on the low end and 8% on the high end, leading to a cost of equity of between 23.5% and 27.5%. With an after-tax cost of debt at 9.1%, we have a weighted average cost of capital between 21 and 25% for a midpoint weighted average cost of capital of 23%. Next slide, Alex.
On the next slide on my screen.
It's not flipping up. There we
No,
go.
we
Thank
were
you.
seeing the next slide, actually.
My computer might have been a little delayed. My apologies there. Now taking a look at the discounted cash flow approach we used for Planet Yay, we grew revenue in line with notorious assumptions, starting at 15% and dropping by 1% annually. Revenue and cost of goods sold grew in line. Sorry, not revenue. Cost of goods sold grew in line with revenue, leaving us as we come down to an enterprise value of between 156 million and 192 million for an equity value of between 155 million and 192 million. Our implied EV over EBIT is between 4.31x and 5.31x. Our implied EV over revenue ends up being 2.35x and 2.95x. A couple key things to mention here. We are, given this evaluation, we are planning on meeting the first earnout target of $20 million in 2025. However, we expect to miss the second earnout target of $30 million in 2026, but expect to reach the third earnout target of $50 million in 2028 for reaching 70% cumulative revenue growth.
Awesome. Thank you, Talon. So go over the market approach and comparables to this, as we can have a nice fancy discount cash flow, but if the market doesn't agree with our valuation, then our valuation will not be correct. So as we can see from the market approach, we can see that we're firmly between the mid and high points for the last 12 months EBIT ratio, and we're around the high point for the last 12 months revenue ratio, which places us firmly in line with market transactions as compared to our discounted cash flow analysis. So as you can see from the market approach, with a low of 95 million and a high of 230 million. And from the last 12 months revenue approach, we have a low of 91 million and a high of 189 million. With our range of approximately 150 million to 190 million in discounted cash flow approach, this places us firmly in line with the market approach. And one key note about the market approach, we did remove Safety Net Company as an outlier, as it is 25 years old, much older than our company, and its ratios were significantly smaller than the other participants in that pool. And so we've removed it to get our range here.
Now looking at MMI, the offer, we use the same methodology for a WACC buildup, only adjusting to the industry for a rounded weighted average cost of capital on the low end between 11 and 22%, and a midpoint weighted average cost of capital of 16.5%. We made the following assumptions and looked at the following drivers as well. So vehicles sold, we expect to increase with analyst consensus, tripling the current growth rates. Production wages, we expect to increase by 25% to try and avoid unionization. Operating expenses grow in line with revenue. Advertising expected to be $2 million for the next 2 years. We're expecting a price increase of 20%, giving us an average price per vehicle of $60,000. We're expecting production costs to drop 5%, and we looked at removing redundant assets in the form of market securities. We also made a number of EBITDA adjustments to ensure that our maintainable EBITDA was in line with our valuation. Next slide, Alex. So taking a look at the top line revenue in 2023 of $7.3 billion, we expect that revenue to grow to $14.6 billion through 2029 for a compounded annual growth rate of 11.3%. Given the weighted average cost of capitals given before, we expect our enterprise value to be between $1.5 billion and just under $2 billion, for an equity value of just under $1 billion and then $1.4 billion. Now, when we look at the share percentage that we were given for this deal, there's currently 700 shares outstanding, giving us a per share value right now as it sits at $2.4 million per share, as it is a private company. After the agreement, they're planning on issuing us 45 shares, which would take us to 745 shares, and the value would then be $2.9 million per share, and we would have a 6% ownership stake, or $130 million. Now, we do expect to meet the $1 million unit sold that would give us an additional 25 shares, pushing our value to 70 million for that one, and a total combined value of $200 million. However, we do have to buy those shares at the current price right now, which would come in for at $60 million for the 25 shares, giving us a total value of $140 million. Now, when we look at this offer from a more qualitative analysis, there is a couple pros and cons. The first major pro is the opportunity to break into a brand new market. This will also give us the ability to focus more on research and development, as MMI will be focused more on the sale of our products. We also have the potential for a very healthy payout throughout the lifetime of this contract. However, when we start to look at the cons, we see that they much outweigh the pros. First, MMI is facing vast public image issues. It's noted that if we partnered with them, it would increase their public image. But what about our public image? This company has been riddled with recalls, lawsuits, and potential of unionization that could tarnish our brand image and a potential to sell products. We also have to look at the exclusivity of the contract. We would not be able to sell our contract to anybody else, and that would potentially cannibalize our own revenue. We also would face a liquidity issue, as the shares are paid out in a private company. They could be decently hard to sell, and we might run into issues if we need cash for operations or for shareholders' interests.
Great. So now let's look at the tech top deal. So if you start at the top, we have the two growth rates. We have the consensus analyst, which is third party, and then we have tech top management. They've predicted a quadrupling starting in 2025 once our technology is implemented. So looking at the second box, that is our consensus license forecast. I'd like to key in the growth rate. We also have primary licensed vehicle units and secondary licensed vehicle units. The primary is $1,250 US and the secondary is $2,500 US. Then we have our license revenue in US, which we've converted to Canadian. And then we also have to keep in mind that source code payout in US of $25 million in year 5, and then the conversion to Canadian. At the bottom, you'll see the exact same model, but set up for the tech top management forecasts. Next slide, please. Thank you. So now let's look at the consensus analysis and how it'll impact our EBIT. On the left, you'll see assumptions that I've just kind of noted to you. And on the right, you'll see revenues pulled from that consensus forecast. We then have our we all then have line items forecasted as a percent of revenue. And we see that when we come to EBIT and we apply our present value factor with a WACC of 23%, we get a sum of our present value EBIT of 150 million, which is on the low end of our valuation range. Now, if we look at the management from TechTop, exact same model once again, just with the new revenue with their growth predictions. Looking at EBIT, we see EBIT, the present value of EBIT, and then the sum of present value of EBIT is $200 million. However, it is extreme, and this is within to the mid to high point of our range. However, it is very important to note that quadrupling growth projections over 5 years is highly unreasonable compared to the consensus. Management always tends to overstate these projections, and the terms of this deal means that the present value of our patents is only $7.25 million. So let's sum up the qualitative considerations once more. We know that Plan EA has no shareholder agreement in place with significant events upcoming. There's a large focus on innovation and has been awarded several patents. And we also know that the company aims to associate itself with positive social causes. When we look at Notorious, we know it's a big public company. We know that there's a consideration of cash or common shares in the takeover option. We know that they have reasonable earnout targets, and we know that the common shares have an 18-month vesting period. When we look at Mac Manufacturing, we know they're privately owned. We know there's a lot of recent negative public media. We know that there's probably the creation of an employee union. We know that 2 distributors have filed for bankruptcy in 2020, and overall the image is very, very poor. And when we look at TechTop, we know that there's unrealistic growth projections over 6 years as a luxury automaker. We know that they're keen on acquiring that software source code from us. And we know that that by accepting the exclusive licensing deal, we're putting the fate of our business in their hands with how many units they can sell. So let's look at the alternatives matrix. All 3 of these deals are within our independent CBV valuation. However, when we consider the minimum guarantees of cash, Notorious does provide that for us. TechTop does not, as it will depend on the sales. And Mac Manufacturing, we've considered as a maybe. As for the appeasement of all shareholders, Notorious deal checks off that box. Mac Manufacturing does not appease our shareholders because of the negative public image, and TechTop would appease our shareholders. However, Notorious checks all these boxes off for us, and that is why we are recommending this proposal.
So to go over some risk and mitigation to this plan, we can see that there's a risk of shareholder dispute before the close of transaction. But because we've identified a new shareholder agreement framework for you, you can follow the provisions of this new shareholder agreement so that you would be able to manage risks of this dispute. Also, there's a risk that earnouts are not achieved by the company in our first deal, Notorious. But because you're receiving that minimum cash payment of $120 million at the start of the deal, you'd be able to invest this money to earn a return on your initial proceeds as compared to any of the other offers. So what have we done for you today? We have gone over how you need to develop a shareholder agreement to manage risk of shareholder disputes. We've also gone over the valuation of all of these different companies and the third-party offers. And so from this, we've determined that you need to proceed with the deal with Notorious Tech using your new shareholder agreement framework so you can mitigate disputes, identify different offers, and make those important decisions about business events moving forward. So for all this, we recommend you go with Notorious Tech, and we're so pleased to take any questions that you have from us today.
Thank you very much for that. That was very good. I'll open it up to the other judges to see if they have any questions.
I don't mind starting it off if unless someone else wants to go ahead. So one of the deal that you're actually recommending that we as shareholders accept is the Notorious deal. And I'm just curious, maybe I missed it. Could you point me to what the value of that deal is? And I think they were offering a combination of cash and shares, or maybe you could just tell me what that, it was 120 million up front. And have you got that value in your presentation somewhere?
Yeah, so it was $120 million upfront, and then there was a potential for 3 earnouts over the lifetime of the contract, with the first coming in 2025 of $20 million, and the second coming in 2026 for $30 million, and the third and final payout coming in 2028 for $50 million for reaching revenue targets.
And so to elaborate on that a little bit more, based on the assumptions provided by Notorious's management, you would not hit the 50% cumulative growth target in 2026. You would hit the 25% cumulative growth target in 2025 to meet that payout metric. You would also hit the end of contract deal payout metric of 75%. We discount all these back to get to the present value of it, and we determine that the present value of the entire earnout clause is $150 million. but you would also have that minimum guarantee of cash upfront of $120 million.
So am I understanding correctly then that what you're calling enterprise value here is the value of the earnouts? And then on top of that is the 120 million upfront?
No, so the enterprise value you can see in the box there is the value of your company today of Planet EA. The earnout would be based on the payout of the metrics from Notorious. So our forecast on the left for you is the enterprise value as determined by our DCF. And then on the right, the present value of the earnout is what the present value of the payouts from Notorious would be.
Oh, the present value of the earnout is 150 million and
Correct.
then 120 million cash up front.
Correct.
And have you addressed the question of whether we take cash or shares for the original 120 million?
Yeah, so we in our alternatives matrix, we went over how there's a minimum guarantee of cash by accepting $120 million from Notorious. Because you'd receive this over shares, because in the Notorious deal, there was a vesting period of about 18 months. With that, the share price could do anything at that point. So we believe from this approach, you'd be able to take that 120 million upfront, you'd be able to invest it, so you have that guarantee of the amount of cash you receive. Then you'd have that additional consideration for further earnings in the future. So we decided that it's best for you to go with cash, as cash is the best way for you to guarantee liquidity for yourself and guarantee what your payout will be.
So the value of that deal is the 150 million earnout plus the 120 in cash.
The 150 million earnout is inclusive of the 120 million cash payment.
Okay, so it's 150 million.
Yes.
Thank you for clarifying that for me.
Of course.
Any other questions? Not hearing
Hi,
any.
I've got a question. Can you talk a little bit more about just some of the things that that you did when assessing some of the comparable companies?
Yes, for sure. We can totally do that. So to go over our comparable companies. So we took all the provided comparable companies in the agreement. We took a look at all these companies from the minimum all the way to the maximum of their EBIT or revenue ratios. And so from this, we found that on the minimum ratio after removing safety net as an outlier, there was a minimum applied multiple of 2.7 and a high applied multiple of 6.4. And for the last 12 months revenue, there's a low applied multiple of 1.2 and a high applied multiple of 2.4. And so in this range, you can see on our chart on the slide here that it places us in that range of 91 million to 190 million using the revenue approach, and 95 million to 230 million using the EBIT approach. So these are big ranges, but there is a difference between the last 12 months between the growth rates of each of these companies.
And did you consider that in any of your selections?
In the selection of our deals?
Yes.
Yes, yeah, absolutely. We did consider it all. We believe that the market approach is a perfect gut check of findings from a DCF, and it also shows to you what the market thinks the value of your business is. Because at the end of the day, if no arm's length market participants are willing to pay for the shares of your offer, then the DCF is not going to provide the same value for everyone else. So we did absolutely consider this, and this is, as you can see from the gray highlighted boxes, we found from our DCF approach that our applied multiple from our DCF approach was able to put us in those gray highlighted boxes in this, which was able to help us gut check and confirm our findings from our DCF.
Okay. Anything else? Any other questions? I'm not hearing any, Kevin.
Yeah, okay, that's great. Well, great job, Team 10. That was excellent. You guys can hop off the meeting now. Thank you very much. And judges, you'll be sent to a deliberation room momentarily.
Thank you, everyone.
Awesome.
Thank you
so much.
Thank you.
the thing. What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at Omers? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
Good afternoon, June 16. We'll be getting started at about 2:05 p.m. The judges are still deliberating.
Sounds good. Thank you.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
All right, Team 16, our judges are back from deliberation. You can go ahead and share your screen and we're good to get started. Good luck.
Thank you.
All right. Hi, my name is Andriana Molinos, and this is
Paulina Molinos.
And today we will present to you an assessment of a takeover bid that Planet Yay has received from Notorious Tech, will be referred to as Notorious from here on out, as well as two other offers. One from Mac Manufacturing Inc., also known as MMI, and TechTop, who are two car automakers wanting exclusive use of Yay's Planet Yeezy digital assistant. So in short, when determining the fair market value of the takeover bid and the two offers received from the automakers, the valuation resulted in fair market values that exceeded Yay's current fair market value as at November 2nd, 2023. And as such, they're all quantitatively viable, but nonetheless, there are qualitative factors such as loss of control, uncertainty of payment, and even synergies, which can be seen on the table, related to the terms of each offer and the bid, ultimately, which were the determining criteria for our final recommendation put forth, which was that we believe that Yay should pursue Mac Manufacturing Inc.'s offer for a strategic partnership with further negotiations. Now, a concise summary of the reasons would be that the strategic partnership would still allow independence to both entities, a collaboration, and the sharing of resources. It would enable the companies to come up with innovative products together. And by developing a partnership agreement, Yay can even participate in future realized profits. But the con is that there would need to be further negotiations required to ensure that the offer better reflects the synergistic value that MMI believes that they can achieve with Yay's technology. So the flow of this presentation will begin by explaining the methodology and the reasoning behind determining the fair market value of the takeover bid, as well as the two offers set forth. But first, in order to determine whether the takeover bid and even the offers are quantitatively attractive, we must first determine the fair market value of Yay. And we did so using the capitalized earnings methodology. Thus, our starting point was finding the normalized maintainable EBIT which is earnings before interest and tax, which was done by basing ourselves off of historical income statement data ranging from October 31st, 2019 to 2023. So EBIT was determined for each year and normalized, taking away any non-operating expenses such as donations. Subsequently, we developed a range of EBIT by using the normalized earnings that most closely reflect Ye's future maintainable earnings, and the years used span 2021 to 2023. Now, after netting this amount by tax, we capitalize this value using a multiplier. Now, this multiplier was obtained by taking a look at public companies that also fall within the same industry of Ye, who sell similar kinds or types of digital assistants, who are similar in their geographic location and even in their company size. We then took a median of the multiples from the companies that are comparable to Ye to obtain the multiple that would be used to capitalize Ye's earnings, which helped us reach our enterprise value. Further, by taking away any amounts owed to creditors, we eventually got to the equity value of Ye, or its fair market value, falling within the range of 61 to 83 million.
All right, so now we introduce to you the first offer proposed to Ye. At face value, Notorious Tech's takeover bid, in either situation, be it the cash payment or the common share payment, results in fair market values that are greater than that of Ye's. But in order to derive these values that we did for each option, we first had to come up with a way to evaluate the earnout. And so the earnout itself is comprised of 3 payouts: $20 million, $30 million, and $50 million. And each of these payouts required a milestone to be achieved by a certain point in time that had to do with their cumulative revenue growth. So Notorious provided us with a forecast on their expectation of Ye's annual revenue increases between 2024 and 2029. And since this is what we assume that they used to create this earnout structure, we used this to see whether or not Ye would actually have the potential to attain each milestone. So what we found is that Ye would only be able to hit the $20 million milestone, and therefore we gave that one a probability of 1. And then for the other 2, we saw that Ye actually fell short of them, and so we gave those a probability of 0. So now that we had each basically payout weighted based on their probability of occurrence, it was time to discount them to present value, and we did so using a discount rate of 8.5%. We found this rate by taking the premium rate that was provided to us of 5% and adding to that the risk-free rate of 3.5%, which is the yield on a 10-year Canadian bond. Once we had calculated this common element between both options, we then proceeded to add the uncommon element. So in the initial cash payment, we added to it the $120 million in cash, because this is something that would be paid to them upon signature of the takeover bid. All while for the common share payment, we added the $120 million in shares using a minority discount. So the minority discount that we used and applied was that of 35%. And we did this for 2 reasons. The first reason is because they would lack the ability to control the company, despite the shares that they would get having a voting right. The reason why is because the ownership interest that they'd have in Notorious Tech would only amount to 3.64%. And the second reason why we use this minority discount is because of the contractual restriction that existed of the shares not being able to be transferred or sold for a period of 18 months, which basically reduced their initial liquidity. And so in the end, we came up with fair market values of $137.7 million for the initial cash payment option and $95.7 million for the share payment option. And we also noted that although both quantitatively viable, the share option actually had the ability to increase in value in the future, because if Notorious were to perform great into the future, then their value per share would also increase as well. Now, the major qualitative factors in this bid are the complete loss of control of Ye Ventures Inc. being one of them. And this is the primary reason for rejecting Notorious's initial offer back in 2021. And this factor does still remain relevant at this point in time. Additionally, the nature of the takeover bid doesn't really seem to be well-intentioned, because Notorious's main motive is to eliminate their competition rather than work with them so that they could create something great. Consequently, despite the fact that the takeover bid does exceed the fair market value of Ye in either situation, we don't feel like these are the right fit for Ye. And now I pass you to Adriana for MMI's offer.
Perfect. So now for MMI, to determine the fair market value of the offer, our starting point was obtaining the fair market value of MMI, which fell within the range of 12.5 to 13.7 billion. But how did we get there? Well, we used the capitalized cash flow methodology, which begins by looking at historical income statement data ranging from October 31st, 2019 to 2023. We then moved on to obtain our normalized EBITDA, or earnings before interest, tax, depreciation, and amortization for each year, making the necessary adjustments for any non-recurring, non-operating expenses. Now, having said such, we understand that in 2021, there was unfortunately an issue with parts received from a supplier, which resulted in substantial vehicle recalls. Consequently, very large expenses such as warranty costs for customers and inventory disposal costs were incurred. But due to the nature of this event being one-time and non-recurring, all such expenses were added back. We also understand that the company expects a salary hike to occur, since MMI is currently paying its employees 25% below the current living wage. Thus, an additional deduction was made to ensure that earnings incorporate all costs which are expected to be incurred now into the future. So these were some of the bigger adjustments we made to obtain our normalized EBITDA across 2019 to 2023. We then made a range, taking the years with the lower and higher EBITDA, but selecting those that were deemed to be the most reflective of earning levels that can be maintained into the future, which gave us our normalized EBITDA between 1.5 to 1.7 billion. We eventually came to our discretionary cash flow range between 1.22 to 1.23 billion. Now, to determine the value that this cash flow represents, which we assume MMI can generate into the future indefinitely, we needed to find our capitalization rate. The first step would be finding the cost of equity as well as the cost of debt of MMI. So the cost of equity is determined by adjusting our risk-free rate to incorporate elements such as MMI's company risk and even risk due to the industry that MMI operates within, which allowed us to obtain a cost of equity of 18%. Now for the cost of borrowing, this was also determined using the long-term borrowing rate on secured loans net of taxes. Using both of these values, we obtained our weighted average cost of capital, or WACC, of 11%, from which we deducted our long-term growth rate of 2.5% to get our capitalization rate, or in this case, our capitalization multiple of 11.6. Thus, taking our discretionary cash flow range that we developed before, we multiplied it by this 11.6 multiple, added our tax shield on the assets to determine our enterprise value. Now, to determine the total amount available to the equity holders, the common shareholders, we deducted any amounts owed to creditors with other adjustments, such as adding back an amount MMI anticipates to receive from an ongoing litigation, as can be seen on the PowerPoint slide. And this allowed us to obtain our equity value, which fell within the range of 12.5 to 13.7 billion. However, MMI is only offering our shareholders 45,000 common shares, with an additional 25,000 valued at its current market value if they hit the 1 million mark in unit vehicle sales. Now, despite the 25,000 common shares being attached to somewhat of a contingency, we ended up including it within the offer since it was likely that MMI would hit that 1 million mark in unit vehicle sales, and we concluded such using MMI's unit vehicle sales forecast from the years 2024 to 2029. And this enabled us to obtain the fair market value of the offer of about 13.1 billion. But MMI is a privately held company and is only offering our shareholders about 70,000 common shares out of the 750,000 they already have issued, which would ultimately result in a minority ownership within the company. And so what this means is that neither shareholder would be able to unilaterally control MMI. Consequently, these shares lack a control aspect that otherwise would be available if, let's say, our shareholders got all the shares of MMI. Likewise, this is also a privately held company. Thus, MMI shares are thinly traded. So if our shareholders, for whatever reason, wanted to sell or transfer ownership of their shares, they may find it very hard to do so. So both the lack of control and illiquidity of these shares incentivize us to implement a minority discount of about 40%. and this reduced the fair market value of the offer to a midpoint of around 734 million. Now, this offer is still quantitatively very attractive in comparison to Ye's fair market value of 72 million. But we must also consider the fact that MMI has identified synergies. Thus, they should be paying for the value they believe they can derive from Ye. So this brought us into our next step, which is determining the fair market value of the synergies, in which a table is provided showing the full calculations within the appendix towards the end of our PowerPoint. Now, we began by choosing the discounted cash flow methodology, or DCF methodology. The market research of MMI revealed that they would be able to triple industry growth projections in vehicle units from the years of 2024 to 2029, which was utilized in determining the incremental growth in revenues of MMI, having now integrated the Ye technology. Likewise, because there was no real mention of their partnership ending, a terminal value was developed, meaning the value of all possible future revenues that can be generated into perpetuity. But to even generate these cash inflows, we would expect expenditures. We would expect cash outflows to be undergone to sustain and create such growth. So capital expenditures and even production costs were deducted, and more detail can be seen in the PowerPoint slide towards the end as mentioned. So with these added considerations, we obtained the net cash flows between 2024 and beyond, which were then discounted to the present value. And taking the sum of this amount, we arrived to the present value of the synergies of about 1.7 billion. As one can see, 734 million for the offer, 1.7 billion in synergies. The offer isn't as quantitatively attractive in comparison, but we still believe there is potential for pursuit. It was noted that our shareholders aren't willing to give up control of Ye, but at the same time, Victoria wishes to retire in 5 years, and Brian is soon getting married and may potentially down the line have kids, which would ultimately take up a lot of his time. So to grow this company to the size we believe it could get to, it requires an innovative approach, making this digital assistant integrated within one's daily life in such a way that eventually no one can live without it. So integrating it within vehicles, something millions of people use every day, can truly be a game changer. Not only would Ye, in collaboration with MMI, become a first mover within this industry to offer such tech, but it also enables Ye and MMI to take advantage of a rapidly growing market that is not yet saturated with competitors. Moreover, being able to move down the experience curve and even take advantage of economies of scale quicker than their competitors. Not to mention that Ye can benefit from the resources of MMI to further grow their own business, coming up with better and improved innovations. So ultimately, the offer of a strategic partnership with further negotiations of the amount stipulated can truly end up creating substantial value for Ye.
All right, so the final offer for Ye's consideration is TechTop's licensing deal. In a nutshell, the offer consists of royalty income for over a period of 6 years of the licensing deal, followed by a one-time payment of 25 million upon expiration on October 31st, 2029. TechTop's management is actually very optimistic about the success of Yeezy's implementation into their luxury vehicles, and they've estimated a quadrupling of the analyst consensus on growth rates of vehicle sales. So using this, we actually made a timeline to map out the royalty income estimated to be earned annually, as can be seen. And with that in mind, the fair market value of TechTop's offer to license Yeezy was found to be 1.064 billion. So this offer is greater than Ye's fair market value, therefore quantitatively viable. But how did we get to this value? So when coming up with the fair market value, we decided to take a best and worst case scenario approach. A forecast of the expected annual royalty income for both the optimistic growth rates and the expected growth rates was obtained. The approach we used generally followed the discounted cash flows methodology, as we relied on revenue forecasts for the royalty income that they would generate on an annual basis up until 2029. In creating these forecasts, the next consideration that was important to us was the fact that this technology would only be rolled out in their vehicles beginning 2025. And so that quadrupling effect that I was talking about earlier would only really begin then. The licensing agreement itself involves a fee of $1,250 per vehicle sold until cumulative sales reach 250,000 vehicle sales, after which point that royalty fee would double. So in the optimistic growth rates, we applied the $1,250 USD between years 2024 to 2026, after which their sales went over the 250K mark, enabling them to earn the double royalty fee from 2027 to 2029. In the conservative approach, TechTop only exceeded the 250 vehicle unit sales mark at some point in 2027. And so we took the liberty of basically applying the $2,500 USD per vehicle from that point until 2029. Finally, in both cases, we had a terminal value of 25 million that we applied. So we then discounted each scenario using a WACC of 12.24%, which was made up of the cost of equity of 18%, which we derived using the economic data provided in the case. And we also used a cost of borrowing that we derived using the interest on unsecured corporate loans, because TechTop didn't mention having any secured loans in their possession. So in the event where the quadrupling did in fact happen, as mentioned earlier, the fair market value of the deal would be 1.064 billion. But in the event where they didn't get the quadrupling effect that they estimated, it would only be $480 million. And so both scenarios are obviously quantitatively greater than the fair market value of Yay, therefore being quantitatively viable. But the downside of pursuing this offer is obviously the uncertainty of meeting that projection put forth by TechTop's management. Not to mention the fact that the range between the smallest and greatest value is quite large. In addition to that, the other risk that they should take into account is the currency. So because this licensing deal is in USD, there is a risk related to taking it on as a result of currency fluctuations. So it's important that if they did pursue it further, that they potentially actually fix the exchange rate to the current exchange rate. So that way they don't risk any losses due to currency exchange fluctuations. So finally, it's also important to mention that the source code would have to be divulged upon expiration of the licensing deal. And this is pretty big. It's a major qualitative factor because EC is currently the company's main product offering, and transferring this type of information might adversely affect their revenues into the future. And this is why we ultimately picked MMI as the best choice to pursue into the future. Now, the last topic of discussion is the shareholders agreement. Up until now, Brian, Eric, and Victoria have operated Yay without one. But with the possibility of changes on the horizon, it is more important now than ever that the three siblings outline certain matters within one. So currently, Eric and Brian are common shareholders within the company, and Victoria is a preferred shareholder. Brian is recently married and may potentially want to involve his spouse into the future of the company, as well as his children. And Victoria plans on retiring in 5 years, and that may mean that she reduces her roles as a shareholder. Maybe she wants to transfer her shares to someone else, or maybe she wants to sell her ownership within Yay. So all these are known as triggering events, and because it's in the interest of everyone to get the best out of them, it's important that they are addressed in the shareholders agreement, along with some others found here on the PowerPoint. So if we take retirement for an example, it should be made clear whose responsibility it is to sell the shares upon retirement. Will it be inevitably Victoria's responsibility, or will the responsibility fall onto Brian and Eric, for example? It's also important that we define what retirement is within the shareholder agreement. So if Victoria says she decides to reduce her role as a shareholder within the company, would that trigger the event of retirement? Or would she have to cease all her responsibilities of a shareholder within Yay for it to happen? Another important element would be the right of first offer. And this is whereby the remaining shareholders have the right to assess and then accept or refuse the offer put forth by Victoria before she actually takes this offer and brings it to someone else. Another type of rule, similar in nature, is the shotgun clause, which would allow the selling party to sell the shares to the other shareholders under fixed terms. And the result is that the shareholders being made this offer would either have to accept it or propose a counter offer that follows these same conditions. Now, in terms of valuating the shares, this is another very important thing because there's a lot of ambiguity and uncertainty around deriving the fair market value of shares. especially because this is a privately held corporation and their shares are not readily traded on the stock market. So it would be important to define the steps necessary to get to that fair market value. Now, finally, potential acquisition would also be something that should be outlined within that agreement. When a private corporation is sought out to be acquired, there's many important factors at play here. For example, Victoria is a preferred shareholder, and so naturally she has no voting rights and wouldn't generally have a say in the direction of the company. But because it's a family-owned corporation, she may want to have a say and may even have a say that she wouldn't have if it was other circumstances. She may also want a similar payout as her brothers if the acquisition were to come to pass. And so these are important matters that should be outlined in the shareholders agreement to make sure that everyone's expectations are met. All in all, creating a shareholders agreement outlines key matters that happen over the lifespan of a corporation so as to avoid future conflict. This has to do with the direction that the company takes, as well as various scenarios that may unfold that relate back to the shareholders of Yay. And that marks the end of our presentation. We thank you for listening.
Thank you so much.
And we hope you enjoyed it.
This was the slide with the added information for the synergies with all the detailed calculations. Thank you so much for listening to our presentation.
Thank you very much for your presentation. That was very good. I'll open up the floor to the other judges to see if there are any other questions.
Sure.
None?
I had a question actually about your calculation of Yay's current fair market value. I don't know if you want to put the slide back up or you want to just try and talk about it without the slide, but I believe you used a market multiple that you applied to the net income of the corporation. And I'm just wondering, were there any other multiples available to you, revenue multiples or anything like that? Did you consider them? And if so, what did you find? Or if not, why did you not consider those?
For sure. So when we came up with the multiples, the first thing we looked at was, of course, the other companies that were available, as well as the company descriptions. So we went through the description, tried to see which ones offered digital assistants that were not entirely exactly the same, but relatively within the realm of assisting someone in their daily life. And then more specifically for the quantitative data, we looked at the enterprise value with the EBITDA, which enabled us to obtain the multiple, but there was also the revenue multiple that was used. And we basically did it relative as well to the enterprise value. And then we looked at it and we also compared the revenues of the other companies to that of Yay as well. One of the multiples we included as part of our calculation was on the higher end. But there were other factors that came into play, such as geographic location, how long they were open, as well as the product. So our range was, although certain values were taken, such as companies with revenues that are slightly higher or lower than Yay, they were still incorporated because ultimately they were quite similar to Yay. So yeah, that's how we ended up with the value.
So the value you determined or indicated value you determined using the revenue multiples, did it fall in line with your conclusion using the earnings multiple?
We primarily used the earnings multiple. We just briefly did the calculation for the revenues multiple and looked at it to compare, but that was it. We did use only the earnings multiple in the end.
Okay, thank you.
Okay, if there are no more questions from the judges, we will adjourn for deliberation. Great job, Team 16. Congratulations on completing your second round presentations. You guys can drop off the call and judges will move you to breakout rooms.
Thank you so much.
Thank you so much.
Thank you.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at OMERS? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at Omers? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at Omers? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
What if the things that captivate you, the passions that drive you, everything that makes you, you, could change perspectives, deliver business-shifting insights, fuel transformation, and uncover limitless opportunities for you, for your community, for Canada, for the world. KPMG, passion to insights, insights to opportunities.
Did you know that at Omers? Actually, why don't you hear it from the team? See for yourself. Come build tomorrow with us.
Good afternoon, Team 19. I was just told I was on mute doing my whole spiel. Apologies. Welcome to day 2. The judges are just taking a bit of extra time to deliberate, so we should be getting started in about 4 minutes here. Apologies for the delay. But as soon as all of them are in the room, I'll give you guys the go-ahead and you can begin. Good
Thanks,
luck.
Kat. Should we share screen now or wait?
We can wait.
Thank you.
All right. I think all of our judges are back from deliberation. So with that, I'll turn it over to you, Team 19. Best of luck. And yeah, enjoy yourselves.
Thank you. We'll just get our screen started to share. Hello, Victoria, Brian, and Eric. Thank you for taking the time to meet with us this afternoon. My name is Vanch, and I'm joined with my colleagues George, Billy, and Dennis. And we are the valuation experts from Planet Ye's M&A division. From our last conversation, we understand that there have been 3 offers presented to you, and through the next 20 minutes, we'll be presenting to you our findings and what we believe you should do. You should do in the upcoming days. Quickly going over the topics that will be covered, we'll first be presenting what we believe the fair market value of Planet Yay Ventures are and the methodologies we use to come to that number. After that, we'll compare it to the number Notorious is presenting you and whether we believe you should go with them or not. If you do decide to go with them, we will present with you if you should choose the cash or shares option. After that, we'll be discussing the other offers that were presented to you by MMI and TechTop, and finally, steps in establishing a shareholder agreement before ending our presentation and opening the floor to any questions. Now, to start our presentation, we'll start with an executive summary.
As we look to the strategic crossroads in front of us, our executive summary will give you an overview of the analysis framework that we've used to guide your decision on the future direction of Yay. Facing quite a significant decision, the M&A team has carefully evaluated each alternative. With 3 distinct offers on the table, we've dissected each of them to assess their alignment with your objectives. Firstly, Notorious has offered a bid with a substantial upfront cash or share payment, which is complemented by an earnout contingent on a future revenue growth. While this is attractive, this hinges our benefits on reaching ambitious growth milestones. Secondly, MMI's offer is to issue shares in exchange for utilizing our technology. This presents us with a unique growth opportunity. Should their sales exceed 1 million vehicles within 6 years, we get the opportunity to invest further at MMI's current fair market value prior to the partnership. However, this is contingent upon their success, which our technology would significantly influence but does not guarantee. Our third and final offer is from TechTop. It's a licensing deal, which provides us with an immediate and continuous royalty revenue. It also has an attractive increase after a certain sales milestone, presenting a clear and consistent revenue stream. Now, after researching the fair market value of Yay through a weighted combination of various methodologies and analyzing each of these offers thoroughly, the team has arrived at a recommendation to accept TechTop's licensing deal. This arrangement promises a steady royalty stream, mitigating the volatility of market conditions and Notorious's performance dependencies. Moreover, it allows us to benefit from the upside potential should TechTop sales surpass 250,000 vehicles, at which point the royalty rate will double, a testament to the scalability of this agreement. Now, the royalty fee structure will span the next 6 years with the possibility for renegotiation and extension, signifying this is not just a one-off transaction, but a partnership that could shape our trajectory well beyond this term. Now, let's talk about our valuation of Yay.
In assessing the valuation of Yay, we also determined the valuation of the Notorious takeover bid and compared the two to determine the reasonability of the offer. To begin, the fair value of the Notorious offer is determined as 151 million, which is the sum of the 120 million upfront payment and the 31 million probability adjusted present value of the earnout. In assessing the probability of the earnouts, we first forecasted the P&L of Yay to assess if they could meet the revenue targets in the criteria, and also considered the fact that our estimates are less certain the farther we forecast out. Shifting to the valuation of Yay, we determined a total weighted average fair value of 459 million, which stems from our discounted cash flow approach, which gave us a value of 600 million, and our 2 comparables of enterprise value to revenue and enterprise value to EBIT, which gave us equity values of 127 million and 132 million respectively. In assigning the weightings to these valuations, we gave the highest weight to the DCF approach, as although the comparables method does provide us some information, the comparable firms we selected and that are present in the industry mainly focus on providing software into consumer products, as opposed to providing software that focuses on digital assistance. In summary, comparing the 2 values, we see that the value of the Notorious offer leaves $307 million of the value of Yay on the table, and we strongly suggest that you do not take this offer, as it will not be successful. Now let's discuss the valuation of the DCF.
Regarding DCF valuation, our projection period is 5 years, which is a standard forecasting timeline. Starting with revenues, the growth rate is 15%, which then steadily declines by 1% each year. Gross margins are estimated to remain consistent throughout, consistent with historical performance at 85% gross margin ratio. We adjusted certain expense items to normalize operating expenses, such as discretionary items, with key assumptions disclosed in a box below. Based on our professional judgment, shareholders are heavily involved with day-to-day operations, although they compensate themselves through dividends only. Thus, we factored in the cost to replace management at $200,000 per manager per year. Weighted average cost of capital is estimated at 9.43% based on Ye's capital structure. Combining all this information with discount the cash flows for the next 5 years, estimate terminal value, and factoring debt and cash positions of Ye to obtain equity value, which is estimated at approximately $600 million. Now let's review relative valuation.
In our relative valuation, we chose to compare Ye to the following 5 companies and gave them a weighting which is correlated to how closely comparable they are to Ye. The company with the largest weighting is On The Go Pro, and we believe that the justification for this is not only its reasonably close years of operation to Ye, but also that its products is not limited to a single use or for a specific demographic like the following 3 companies, Marquise and FitPlan, which are focused for more of that athletic market, and DoorSense, which is focused on for garage doors specifically. Since it is the most related, we gave it the highest weighting and distributed the weight equally to the other 3. The final company we chose, SafetyNet, we gave the lowest weighting due to how long it has been operating compared to Ye. Since it has been operating 2.5 times longer than Ye, we decided it is not as comparable as the other 4 chosen. Keeping all of the above into consideration, we gave to a weighted average of 1.57x for the EV to LTM revenue multiple and a 3.53 EV to LTM EBIT multiple. Though the below calculations we found in a relative valuation, the value of Ye would be between 122 million and 127 million. Now, let's say you accept Notorious's offer. Which option should you choose, cash or shares?
So now that you understand our analysis of Notorious' offer, the team recommends the option of receiving the initial payment in Notorious shares rather than cash. Let's examine why this is the most beneficial route for you. Now, firstly, opting for shares over cash allows you the significant advantage of deferring capital gains tax. The immediate tax implications of taking the $120 million in cash would be substantial, given the high capital gains tax on the $60 million and the limited capital gains exemption available to us. Now, in contrast, choosing shares would spread the tax burden over multiple years, keeping more cash in your pockets. Furthermore, by accepting shares, you're presented with the potential for appreciation in the value of Notorious' stock. Now, they've had a successful IPO, and with our technology under the banner, there's a strong case for continued growth. This appreciation, along with the possibility of Notorious dividends, represents a financial upside that cash does not offer. Of course, we must also acknowledge the associated risk with this decision, as share prices can fluctuate and Notorious' future growth is not guaranteed. However, the financial landscape and Notorious' current market position suggest that this risk is both manageable and worth taking. In summary, accepting the payment in shares is the strategic move that aligns best with your long-term financial interests. It not only offers a tax-efficient strategy, but also potentially allows you to benefit from the growth that we're confident Notorious will experience with Ye's technology propelling it forward. Now, let's examine the other 2 offers on the table.
In addition to the takeover bid from Notorious, you have been presented with offers from vehicle manufacturers, Mac Manufacturing, known as MMI, and TechTop. Looking at the offer from MMI, it is a strategic partnership with compensation provided in the form of shares, and we have estimated the value to be between $354 million to $423 million. Looking at the offer from TechTop, it is a licensing agreement with royalties provided throughout the life of the agreement and a lump sum payment at the end in exchange for the source code of our software. And we have estimated the value of this offer to range between $753 million to $3.1 billion, depending on when the source code is provided. In terms of qualitative considerations, either deal would enhance Ye's brand recognition and allow for future deals to take place in the market. However, MMI has recently suffered negative publicity due to their vehicle recalls and safety issues, and TechTop has requested early access to the source code, which, if provided, could enhance the value of the agreement. Now let's delve into the valuation of MMI. Turning to MMI, we decided to use the capitalized earnings and capitalized cash flows approaches, as given that MMI is a mature industry with relatively stable historical information, we believe we can reliably ascertain the market value of MMI. In this method, we began by normalizing earnings, which included removing certain one-off items and also adjusting for removal of the dividend income, as that was a passive investment, adjusting labor costs to the market rate, and removing the discretionary portion of meals and entertainment, leaving only the monthly staff lunches as a line item. Next, we determined the maintainable range of earnings and assigned our best case to be the maximum of the range, which is the 2023 results, and the worst case to be a 3-year weighted average of the most recent 3 years, with the weights assigned at the most recent year and decreasing as we went backwards. Next, our discount rate was determined by first starting with the cost of equity, which incorporated the 10-year government bond yield as our risk-free rate, a 10-year equity risk premium determined as the midpoint between the 5 and 15-year rates, and adding on additional liquidity premiums and industry-specific risks, bringing us a total cost of equity of 16%. In addition, our after-tax cost of debt incorporated the 6% interest on secured corporate loans, giving us a weighted average of 11.26%. Now let's further dive into the valuation of MMI. As we can see, after accounting for the income tax effects, tax shields, redundant assets, and debt, the final overall pro rata equity value under both approaches is highly similar. Therefore, in our overall analysis, we only consider the capitalized cash flows approach, as it better reflects the market value due to its incorporation of capital expenditures and the tax shields. In addition, our multiple was the 11.4, considering our WACC and our 2.5% growth rate. And further, we did include the additional 25,000 shares per the agreement, as we believe you will be entitled to them, because we have forecasted the unit sales of MMI incorporating the partnership with us, and the unit sales far exceed the 1 million unit requirement. Now let's discuss the valuation of TechTop.
TechTop's licensing agreement is commission-based, which makes the value of this deal heavily tied to vehicle sales. On top of commissions, TechTop will buy out Ye's voice recognition software for $25 million at the end of the 6-year licensing agreement. There are currently 2 scenarios: provide the source code to TechTop upon expiration of the license, or provide the code upfront. We estimated cash flows from commissions under each scenario, and there is a material opportunity cost. Providing the source code upfront will quadruple TechTop sales by 2025. Present value of generated cash flows by Ye will be staggering $3,164 million Canadian dollars. Thus, providing the source code upfront would be more beneficial, although we recommend including several additional clauses under the software license agreement to ensure that TechTop honors their end of the agreement in good faith. The discount rate used comprises of 10-year dividend yield, which is the benchmark for the risk-free rate, and an additional company-specific premium totaling 8.5% discount rate. Now let's review relevant items in establishing a shareholder agreement.
So as we stand on the horizon of a new age for Ye Ventures, it's time to formalize our operations and protect the company's legacy through the creation of a shareholder agreement. This document will serve as our charter to guide us through the complexities of corporate governance and shareholder relations. Let's dive into the 4 key components that should be incorporated in our first ever iteration of the shareholder agreement. These are by no means all-encompassing, but what they are is essential. Firstly, value. We must have a robust mechanism for determining the value of our shares. Now, a fixed price is too rigid. Therefore, we need a formula that takes into account financial performance, market conditions, and maybe even net book value. All of these will allow us to have a more dynamic and fair assessment. In the event that there's ambiguity, we can also engage in independent CBV's assessment. Secondly, liquidity. Liquidity is a cornerstone of shareholder flexibility. With Victoria's impending retirement, we need a concrete succession plan for her. Rights such as the right of first refusal ensure that shareholders looking to exit provide the remaining shareholders the opportunity to purchase shares before they're offered to external parties. Now, tag-along and drag-along rights ensure that all shareholders, whether they're majority or minority, can participate fairly in the sale of the company. And finally, preemptive rights protect shareholders against their dilution of ownership by allowing them to invest further during share issuances. Our third cornerstone is decision-making. For pivotal decision-making, the agreement should outline clear protocols. Now, these decisions, such as mergers, acquisitions, or changes to the core business strategy, will require a supermajority vote or perhaps even unanimous consent between the 3. We'll set precise voting thresholds and define a mandatory process for decisions of gravity. Additionally, we'll require a deadlock resolution mechanism. This is critical to ensure that Yay is not paralyzed in terms of decision stalemates. Our fourth and final cornerstone is security. With Brian getting married, one key consideration is having both partners sign an agreement that Yay shares are not part of the marital asset pool to maintain shareholder decision-making. In terms of security, the agreement should also codify a conflict of interest policy. As our lives and business interests evolve with Victoria planning retirement and Brian entering a new phase of life, it's essential we have a framework that identifies potential conflicts, mandates disclosures, and outlines a course of action for resolution. To this end, we'll require non-compete and confidentiality clauses to safeguard our market position. These terms will define the scope of non-compete, outline confidentiality obligations, stipulate breach penalties, and ensure the proper return of proprietary information when a shareholder exits the company. So to conclude, the shareholder agreement we're forging today is not just about maintaining operations, but securing Yay's tomorrow. It'll provide a foundation for fair and transparent governance, protect each of your individual and collective interests, and preserve Yay's innovative spirit and its technological assets. With these key components, let's strive to build a framework that ensures our company's resilience and prosperity for the years down the road. Moving on, before we close with our summary, let's take a look at some of the additional considerations that our team factored in. Now, in the world of valuation, we'll always be dealing with the uncertain, but it's vital that our decisions are grounded in a bedrock of reliable assumptions. To ensure the reasonability of our projections and forecasts, especially in relation to vehicle sales growth when it comes to tech top offer, we've taken 3 key steps. Firstly, we engage in consultation and a historical comparison of the vehicle sales rates provided to us. This involved delving into auto industry reports and dissecting historical sales data, allowing us to anchor our assumptions in the reality of industry performance and historical precedents. In the pursuit of objectivity, we conducted peer review. This process involves subjecting our various analysts to have each of their own independent valuations, bringing them to the table. This collaborative effort helped us to challenge our biases and refine our projections. And finally, we employed a sensitivity analysis, which you'll see in our appendix, as a critical tool. We know that Yeezy is a fantastic tool, but quadrupling sales is a big if. By assessing the impact of varying growth rates, we could understand the elasticity of our assumptions and the potential implications of market volatility. This not only tested the robustness of our models, but also prepared us for a range of market conditions. Now, if we look to the bottom right, here's the key considerations we should consider in drafting a licensing agreement with TechTalk. There are exclusivity. We have to determine the boundaries of exclusivity that we're comfortable granting them, as it's in our best interest to not limit our ability to engage with other potential partners. Secondly, quality control. It's imperative that we establish stringent quality control processes to uphold the high standards that customers expect from Yay and Yeezy. This will protect our brand and reputation. Thirdly, IP ownership. We need absolute clarity on the ownership of the IP. How will Yay retain control over software, or will Yay retain control over software? Fourthly, minimum performance thresholds. To mitigate the risk of TechTalk's relative inexperience in the auto sector, we should implement performance thresholds within the agreement that, if not met, would allow us to reevaluate the terms or pursue other opportunities. Now, we've covered quite a bit in these past 20 minutes, so let's wrap things up with a quick summary of our key points.
To summarize all that we have discussed today in today's meeting, through our valuation methods, we found the fair market of Yay to be 527 million Canadian dollars using a 70-20-10 split between our DCF and comps. Looking through all the offers, we believe TechTop is the best out of all the options. As we see in the bottom left, the second option, where we provide the source code as soon as possible, has a over 400% difference from the next highest offer. Other key factors to include are that shareholders do not to permanently give up their involvement in Yay at the time. Victoria plans to retire in 5 years. The alliance with TechTop with eventual sale of source code would provide sufficient time for proper development of succession plans and transition processes. With that being said, I would like to thank you for your time and once again, open the floor to any questions you may have.
Thank you very much for that. That was very good. Maybe open it up to the other judges for any questions.
Maybe I'll start it off. You've included the value of the 25,000 additional shares of MMI in your analysis, and I'm just wondering, did you also deduct the cost that would be incurred to purchase those shares?
We believed, based on our interpretation of the offer, that these shares would be purchased at the current price. Gevorg, if you want to speak further.
Yeah, absolutely. So the original arrangement is that the shareholders were able to buy those shares at the same price as they are as of today's valuation. And we do not think that there will be any additional costs associated with the share issuance, at least not material that would significantly change the value of this offer.
So I guess I'm just not clear. So did you deduct the cost based on the current share price?
We haven't, because we believe that there will be minimum to none additional costs for issuance.
Thank you.
I have a question. Did you happen to reconcile the difference in, I guess, discount rates and WACC between MMI and Tech Top? You think about the relative differences in those two offers and the various rates used?
Yeah, absolutely. I can take over that. So for MMI, we did use the capital structure of MMI because we did have their balance sheet items, and that was our main source of calculation of their WACC. We did add an additional industry risk premium, which is related to the vehicle manufacturers, and additional liquidity premium, which is associated with a private company, MMI's private company, which is less liquid. For Tech Top, we did use 8.5% as a basic benchmark. However, we did not have much information about their balance sheet information. Thus, we did an additional sensitivity analysis to see how the NPV would play based on different percentages. So even at the worst case scenario of 8-10% and vehicles reaching the base scenario, they would still be better off compared to other offers.
Okay, thank you.
Okay, if there's no more questions from the judges, we're going to adjourn to deliberate. Thank you, Team 19, for a great presentation to end the day. You guys can drop off the call when you're ready, and make sure to tune in at 4:30 for the finals announcement on YouTube.
Thank you for your time.
Thank you.
Thank you, everyone.
Take care.
So judges, we'll put you back in the breakout room momentarily. All right. Good evening, everyone. Welcome to the closing remarks and awards ceremony for CBV Institute's Business Valuation Challenge 2023. My name is Kevin Flother, and I'm the Communications Manager at CBV Institute. It's my pleasure to welcome you here today. In just the second year of this competition, we've witnessed impressive growth with even greater participation from business schools across the country. All indicators suggest that this event will only gain momentum in the years to come. On behalf of CBV Institute and our network of business valuation professionals, I would like to once again congratulate all of this year's participants. The caliber of your analysis and your professional presence has impressed the judges to no end. In particular, congratulations go to the 5 teams who proceeded to today's final round. This year, our awards and honors ceremony, or our awards, will be announced by one of our title sponsors. Momentarily, I will hand the mic to Derek Mello, who will be speaking on behalf of KPMG. Derek is a partner in the valuation services practice. In his role, he specializes in the preparation of valuations of private businesses and public companies for the purposes of merger and acquisition transactions, divestitures, income tax planning, litigation, corporate restructurings, executive compensation plans, and financial reporting. Derek, over to you.
Thank you, Kevin, and thank you to the CBV Institute for hosting the BV Challenge. We are happy to be title sponsored along with OMERS. Like last year, the presentations were excellent. I was so impressed with the amazing effort and caliber of the presentations, as well as the understanding of and interest in valuations at the university level of education. If and when you further pursue valuations, you will find that there's always more to learn. The CBV Institute, through its education program to obtain the CBV, provides an excellent foundation. Valuation firms like KPMG and other settings provide additional training and further provide real-world situations like the Yay case. I've been doing valuations for over 25 years, and there's always something new. Personally, I very much enjoy the valuations field as it brings together many other disciplines. For example, accounting, finance, strategy, and economics, to name a few. At the end of the transaction, ultimately, all the inputs and work streams flow into value, thus making valuation central to any decision-making process. Now, without any further delay, I will announce the winners. In third place, from Toronto Metropolitan University, is Team 19. We have George Chibachang, Billy Arsenault, Vansh Sinai, and Dennis Chen. Congratulations. In second place, from Concordia University, we have Team 16, Paulina and Andriana Malunas. Congratulations. And in first place, Team 2, from the British Columbia Institute of Technology, Sangbang Wu, Jinwook Ryu, Maya Kairi, and Paula DeBlois. Congratulations to you all. Kevin, I'll pass it back over to you.
Thanks so much, Derek. On behalf of CBV Institute and the CBV Network, congratulations to our top teams. A quick note for the top 3 teams before we finish. A member of the BV Challenge team will be in touch via email over the next 24 hours to discuss the next steps. Now, it's finally time to close the door on BV Challenge 2023. Thank you to the students representing business schools from across Canada who accepted our challenge. Our esteemed panel of judges who volunteered their time and expertise, and, of course, our sponsors who stepped up to support our second annual business valuation case competition. Your combined efforts helped us exceed our wildest expectations. We're already looking forward to Business Valuation Challenge 2024. Thanks, everyone, and have a great weekend.